Australia's super system holds nearly $4 trillion. Most of it got there because of employer contributions made automatically on Payday. But the system is also one of the most tax effective structures available to ordinary Australians, and most people barely use it beyond the mandatory minimum. The difference between using super strategically and drifting through it on defaults can be worth tens of thousands of dollars over a working life. This video explains how the tax inside super actually works and where the levers are. Start with the basic structure. Super contributions come in two types, concessional and non-concessional. Concessional contributions are pre-tax. They include your employer's superannuation guarantee payments, now 12% of your ordinary time earnings from 1st July 2025, plus any salary sacrifice you arrange on top, plus personal contributions you claim as a tax deduction. When concessional contributions go into your fund, they're taxed at 15% inside super, not at your marginal rate. For most working Australians, that gap is the core of the tax advantage. If you earn $60,000, your marginal rate is 19%. The gap between your marginal rate and 15% is 4 percentage points. Every dollar of concessional contribution saves you 4 cents in tax compared to receiving it as income. If you earn $100,000, your marginal rate is 32.5%. The gap is 17.5 percentage points. Every $10,000 of salary sacrifice saves you approximately $1,750 in tax that year. Non-concessional contributions are after-tax money you put in on top. No deduction for these, but the earnings they generate inside super are taxed at 15% or less compared to your marginal rate on investment earnings outside super. For long-term wealth building, this is meaningful. The caps define how much you can put in each year. The concessional cap for 2025 to 26 is $30,000. This includes your employer's SG contributions. If your employer is paying $12,000 in SG, your remaining salary sacrifice room is $18,000. The cap rises to $32,500 from 1st July 2026. The non-concessional cap for 2025 to 26 is $120,000, rising to $130,000 from 1st July 2026. The bring forward rule allows eligible members to contribute up to 3 years' worth in 1 year, $360,000 under current rules. But this depends on your total super balance and age. The carry forward rule is the one most people miss. If your total super balance was below $500,000 at 30 June in the prior year, and you haven't used your full concessional cap in recent years, you can carry forward the unused amounts for up to 5 years and make a larger concessional contribution in a single year. This is especially useful after a career break, parental leave, or a period of reduced income. Once money is inside super, how is it taxed? In the accumulation phase, while you're still working and building your balance, earnings inside the fund are taxed at a maximum of 15%. Capital gains on assets held longer than 12 months are taxed at 10%, a 1/3 discount. Compare this to the same investments held personally. If your marginal rate is 32.5%, your after-discount CGT rate outside super is approximately 24%. The gap is significant over time. When you move into the retirement phase, converting your accumulation balance to an account-based pension, and you're over 60, earnings and withdrawals from that pension are tax-free. No income tax, no capital gains tax, no Medicare levy on those earnings. The transfer balance cap, currently around $2 million, limits how much can move into that zero tax environment. The rest stays in accumulation phase, still taxed at 15%. Two additional tax points that don't get enough attention. Division 293 tax. If your income plus concessional contributions exceeds $250,000, the ATO levies an additional 15% tax on those contributions. That means high earners pay 30% on concessional contributions, not 15%. The tax advantage still exists above $250,000, but it's halved. If you're near this threshold, the calculation changes. Division 296 tax from July 1st, 2026. If your total super balance exceeds $3 million, earnings attributed to the portion above $3 million face an additional 15% tax, 30% total on that slice. First assessment will be for 2026 to 27 earnings. If you're approaching that threshold, the tax efficiency of continuing to build the balance above $3 million diminishes materially. For lower income earners, those with adjusted income below $37,000, the low income super tax offset, or LISTO, effectively refunds the 15% contributions tax. For those earners, compulsory super is completely tax-free at the point of entry. The 2026 changes worth noting for strategy. Concessional cap rises to $32,500 from 1st July 2026. If you're currently salary sacrificing to the full cap, you can increase from 1st July. If you're not at the cap, the carry forward window for unclaimed amounts from 2021 to 22 closes after this financial year. Use it or lose it. Super on government paid parental leave begins from 1st July 2026 for babies born on or after 1st July 2025. If this applies to you, confirm your super fund details are current so the payment reaches the right account. 3 moves to take now. Move 1. Know your rate gap. Find your current marginal tax rate. Look at your income bracket in the ATO's 2025 to 26 rates table. The gap between your marginal rate and 15% is your per dollar tax saving from each additional concessional contribution. For most people earning above $45,000, that gap is at least 15 percentage points. That's the case for prioritising salary sacrifice over cash savings. Move 2. Check your cap room for this year and carry forward. Log into ATO online services via MyGov and navigate to the Super section. You can see your year-to-date concessional contributions, your cap, and your carry-forward entitlement. If you have unused cap amounts from prior years and your total super balance is below $500,000, you may be able to make a larger contribution before the 30th of June. Move 3. If you're over 50 or approaching retirement, check how much of your balance is in the taxable versus tax-free component. This affects the tax treatment of any death benefit paid to non-dependent beneficiaries. Non-concessional contributions build the tax-free component. Concessional contributions and earnings build the taxable component. Structuring this balance over time with an advisor can meaningfully reduce the tax cost for your intended beneficiaries. This is general information, not personal advice. Your super tax position depends on your income, balance, contribution history, and retirement timeline. A licensed financial advisor can model the tax impact of different contribution strategies for your specific circumstances. If you want to understand the specific super changes taking effect from 1st July 2026, including Division 296, Payday Super, and the new PPL super payments, subscribe. New video every week. There's a plain English version of the 3-move tax super strategy in the newsletter, link in the description. This is the fine print AU, because someone has to read it.